All right, well, joining me now to talk markets as the S&P 500 is set to extend its record high at the open is Michele Schneider. She's a chief strategist at MarketGauge, joining from Santa Fe, New Mexico this morning. Michele, it's great to see you, and how does the market look to you?
Well, obviously, we're all thrilled about seeing new all-time highs, considering what we went through, as you mentioned at the top. The first half of the year has been volatile at best. But I'm always in the wall of worry camp until certain things resolved, and that's what we're watching for. And I think the number one thing really would be the consumer and what happens in that sector, which is really far behind. Peaked in 2021, Kristen, number one. And number two is what happens with the dollar, because that, of course, is going to affect the consumer. We have this huge spread now between what's happening with growth and what's happening with small caps, retail, and transportation, which is the U.S.-centric focus of the U.S. economy.
Yeah, I do want to talk about trade, Michele, because we are seeing new deadlines set to take effect in early July at the same time that this tax cut and spending bill is making its way to the president's desk. How could that impact markets as we start the second half?
Well, there's a couple of ways it can go. In the most optimistic way, similar to what we saw in 2021 when the consumer was really coming back and spending because of stim money, is that we now have some kind of a tax cut that will really basically incentivize people to spend more money. We need that. So that could be a positive impact. Of course, the negative impact is that it's not really enough to really stimulate more spending in the consumer, and instead weakens the dollar further, and then may give somewhat of a tailwind to inflation, which right now looks more disinflationary, but we're on that sort of edge between disinflation and stagflation, and we don't really know yet which way it's going to go, regardless of what's happening in SPY and in NASDAQ.
So I do want to talk oil, Michele. I know that you've referenced some of the certain sectors that you're watching here, but oil did see a volatile stretch, certainly as this conflict between Israel and Iran escalated. What does that mean for that commodity?
Well, it's so interesting because we have a lot of bad news that has come out, obviously, after now. When I say bad news for oil, good news for peace with the Middle East. But essentially, we were already getting somewhat bullish in oil before the conflict at $62 a barrel. That was a good clearance after OPEC Plus had raised their production. And now supposedly going again with the same number of barrels. I think it's 411 million barrels or something like that. But the point is this. Even after we saw that spike up to around 82 during the war, and we've come back down, we're still stabilizing here in oil at around $65 to $66 a barrel. I would change my mind about any bullish potential under 64, and I would certainly be more interested in potentially looking at oil not only as an oil trade, but what impact it might have to what we were just talking about, stagflation or disinflation, if it can get back over, let's say, $68 a barrel. So we're in a range right now, but it certainly doesn't look too bad as long as it holds here.
Yeah. Before we talk about some of your individual picks, I know some of them listed here at the stock exchange, like ELF, for instance. Michele, I do want to ask about how the Fed factors into this. I know you've been mentioning inflation, disinflation, the potential for stagflation. What is the role of the Fed in terms of rate cuts that you think might be warranted?
Well, again, you can make so many arguments one way or another. At new all-time highs in the indices, why would the Fed need to cut? With inflation coming down, though, it's possible that they should. So it goes back to what we originally talked about, Christy, which is the consumer. The only reason that I could see the Fed saying, oh, we need to stimulate the economy is because 70% of the GDP is the consumer sector, and they are still suffering, for lack of a better word, with these higher rates and now the dollar coming down. So
we did see Michele's feed there freeze just a little bit. Michele, we're going to iron through those audio factors. So I do want to bring you in back here, Michele, talk about some of your picks. I know ELF Beauty is one of them. What can you tell us that attracts you when it comes to ELF Beauty?
Well, it's really a disruptor in terms of beauty, in that they have had some really great strides in terms of being very diversified, very global, a good cheap line. It's recession proof because women especially will go out and buy makeup. It doesn't cost that much compared to, let's say, taking a vacation. And I do believe that they have a good, solid business plan. They made a recent partnership with Bieber's wife, and so I think that I like Elf. It's again been climbing. I like it around this 120 to 127, which is where it's trading right now. I think it gets through there. I don't see any reason why this can't go up further.
Yeah, it looks like Made in America on your list too. Michele, wish we had more time as always, but thanks so much for getting up early and joining us this morning. Michele Schneider, she's a chief strategist at MarketGauge.
Thank you so much.